Howdy, Jacob here. Today we're doing a one-off on UnitedHealth Group. So let's start looking at it. Healthcare provider and services industry, pretty well-known company. I feel like a lot of providers, if you got insurance, would definitely be through here. 436 billion market cap on 465 billion enterprise value. Yeah, it's pretty big here. The debt situation at 28 billion net debt, not too concerning given their market cap and how much they earn. Revenue growth astounding, where in the last 10 years their lowest year-over-year revenue growth was 6.2% from COVID. After that, just thriving double digits, very impressive. Gross margin is relatively flat. Operating margin, not relative, it's extremely flat. Very impressive. I will say premiums for stocks can also come from consistency. So just knowing what's going to happen or having a very high probability of understanding what's going to happen creates premiums as well. Think about Coke. They don't have a lot of growth ahead of them. Well, they do, but you know what I mean? There's not an immense amount of growth given comparing that to some of those young tech companies, but it's going to be very consistent. You're going to know what you're going to get. And here's the same thing. I mean, in the last 10 years, their range of gross profit is 23.4% to 26.1%. And on the operating margin side, it's 7.0% to 8.8%. So very impressive margins here, very consistent. Definitely gotta like that from a investment standpoint because then you have a higher probability of getting of projecting out correct more accurately. But just keep that in mind that companies like this, if you are able to purchase them at a big discount, even bigger of a plus for you because a lot of other people you got to think are also able to calculate and project out their earnings and free cash flow more consistently. So there is a premium, but also bigger competition to other investors. So it's just sometimes tough to get at a good discount. But earnings per share up massively, return on invested capital low double digits, but just very impressive. Low teens, absolutely astounding. Balance sheet 25 billion, about 30 billion extremely liquid assets with about 62 billion short-term long-term debt. That 62 billion is just over 2 years of their 5-year average free cash flow, between probably about 2.5 years. So really no concern there. Their use of cash is very heavy on acquisitions. So we are seeing, if we just look at the last 5 years, I would say that about 50% of their cash from free cash flow is being used towards acquisitions, and then maybe 20%, 15% towards reinvesting. That dividend payout is, maybe a third, and then the rest they're going towards stock repurchases. So they have been issuing debt pretty consistently since. Well, there's only 1 year that they repurchased debt. Maybe their shares weren't cheap, so that was just their use of cash. But at least recently, just issued debt for their having extra use for cash. Which, again, given their debt situation, I'm not too concerned with. They're just going into a little bit more debt to fund some of the things they want to do. But I think I'm ready to make some assumptions here. Absolutely fantastic company. It's already so big, though. How much growth they're going to get ahead of them, I feel like, through acquisitions as well as just growth of healthcare in general. I probably wouldn't be surprised if they could grow at 7% or so. Um, Again, that might be low for everyone out there, but for me, being as conservative as I am, that's just where I'm at. Do your own assumptions. Call me a goob. It is what it is. But margin side, I mean, it's so consistent. I'm just gonna do 6 and 6. Like that's amazing. Share changes. Um, they've been buying back 6 billion aggregate recently. They're probably going to be able to repurchase 1% a year. Terminal PE, I mean, 20, just because of how consistent it is. I feel like other companies can have better margins beyond the 8% that we have here, and even gross 24%. But the level of consistency you get here is a very impressive factor. And then on the dividend side, they've been increasing it. I'll probably just increase it pretty close to what their um, margins are for what their revenue increase is. And yeah, to me, still, I mean, again, I try to look for companies that are stupidly cheap. And if I can get a good one if I can get a fantastic company for a good price, sometimes I'll pounce on it. Um, in some of those portfolios where you get less options. But for my personal portfolio, I definitely just try to max out return as much as possible. But I could easily see how someone could think that this could be a buy at this price. I mean, if you just go to 10% return, if that's all you want, I mean, it's looking like a buy for you right now. So do your own research on it. I think it's a great company, and I would absolutely love to own it at the right price. But for me, just a tad on the too much side. I'm not even going to say expensive because it's. I think you could easily say that it's a buy today. But for me, with what I'm looking for, it's just not. Uh, it's just not there yet. So hopefully you enjoy the video and have a great day. Thank you.